Hello, everyone. Welcome back to another edition of Premier Investments and Wealth Management. It's the financial program here, and we've done it on YouTube. It's also on the radio and through the iHeartRadio app as well. My name is Doug Wagner, your host. I'm going to introduce the gentlemen who are next to me to complete the rest of the program here in a bit, but I need to ask you a question. Are you ready for retirement? If you're like most Americans, you probably aren't, and that's okay. That's what Premier Investments and Wealth Management is here for, to help you get ready for retirement. Just go to premieriwm.com and then click Get Started. From there, you just answer a few questions. They will provide for you, at no cost to you, a look at one-page Premier Vision document. This is a look at your financial future and what you could do by working with Premier Investments and Wealth Management. It makes sense to do so because you don't know probably if you're ready for retirement. They can help you get more confident in that. Again, premieriwm.com, click Get Started, and it's a free, no obligation consultation. If you're interested in getting in touch with them right now, just call and schedule your appointment the same way, 800-383-6590. To my right, Vice President and Wealth Advisor, Elias Randel. How are you, Elias?
Good, Doug. Hello.
Good to see you.
You too.
How's the sheriff?
Doing well. How have you been?
I've been hanging in there. It's
Good.
Hanging in there. It's been a long slog, but we're here now. That's good. I'm glad. It's nice. It's comfortable, safe place.
It's always fun to be with you.
You as well. Also, wealth advisor with over 30 years of experience in the investment industry, Jonas Everett. Jonas, how are you?
Good, Doug. How are you?
Good. Yeah, there we go. Fabulous.
Yes.
They couldn't see you for a second. They just saw this microphone.
Just the microphone.
Yeah, that's fine. That's okay.
It's a good-looking microphone, though, Doug.
To his right, he's got over 22 years of experience in the investment industry. He's an accredited investment fiduciary. He's the president of Premier Investments and Wealth Management, as well as a wealth advisor. He is the big kahuna, Roger Abel. Roger, got the blue memo today. Awesome.
Color coordinated.
Exactly.
How are you?
I'm doing well. How about you?
I'm doing well.
Fabulous. I'm glad to hear about that. We're going to get to talking about what lower interest rates may mean for investors, because this is something we know the Federal Reserve has been talking about over and over again. But before we get there, we need to go to Jonas to get his money tip of the week. Jonas?
Yeah, this is kind of neat. All this talk about lower interest rates, I'll just kind of jump with this idea and kick it over to the guys. But we get asked what type of, we have people that want to buy homes, different homes all the time. And we get asked, what's a better deal, a 30-year mortgage or a 15-year mortgage? This idea came to me in the kitchen, just cutting an avocado.
Yeah. Okay.
Basically, a 15-year mortgage, you're going to have basically half of the interest.
Yeah. Avocado.
You're gonna have a higher payment, but you're going to have half of the interest, and it really makes an impact. If you have a $100,000 loan at 6% interest over 30 years, you have about $115,000 of interest on that. And good luck trying to find a $100,000 home, right?
Exactly.
So,
well,
you times it by 3 or 4 usually.
Not sure if you want to live there.
just the dirty math. You could times that by 3, times that by 4, whatever price of house you're looking at. Over a $100,000 loan at 6% over 15 years, it's about a little bit over $50,000 of interest. So remember that avocado, and don't get in a big hurry. We always say, see if the math pencils out. If you have, if your household has very good income, you have the down payment, and you're able to swing that 15-year mortgage payment, it might very well be worth it for you to save all that interest over your lifetime.
There might be some areas where you may not want to sacrifice that at some point, Roger, because it's like a difference in, how am I going to do my lifestyle choices or my lifestyle investments, like Jonas might say.
Maybe. Typically, though, we like to see people have that mortgage paid off and they retire. If somebody's in the situation where they can afford a 15-year mortgage, but they don't want to be locked into that higher payment. One thing they can do is take a 30-year mortgage and make the payment of a 15.
Okay.
Does exactly the same thing, right? If the 30-year payment is $3,000, the 15-year is $4,000, we'll just pay $4,000.
Okay.
And you'll have it paid off in 15 years. So honestly, Doug, if they can't afford the 15-year mortgage, they probably can't afford the house. Like if you're choosing between a 15 and a 30-year.
Okay.
Yeah, I mean, 30 years really, nobody pays on that 30-year mortgage forever. What really happens, people get stuck in the trap. They take a 30-year mortgage, and in 5 to 7 years, they end up doing a couple of things. They either move or they refinance. And guess what they move and refinance to? A 30-year mortgage.
Right.
And inherently, when you take a mortgage type debt, you pay all the interest first. So you're not making any headway.
Right.
So you're really better off doing a 15-year, at least making the 15-year payment on it.
So this is really interesting, Elias, because when you think about this, we bought our house like 5-6 years ago, and we got a 30-year mortgage. They're thinking, okay, either they're going to sell, refinance, or they're going to live in there until they're 80 and pay it off. And I'm just thinking about that is really kind of a crazy thing. The banks are going, 80 years old, and he's still paying on that house.
Well, the banks aren't scared to loan you money for that long. What's your plan for it? Do you make accelerated payments? Or are you going to pay on it until you're 80?
No, we're probably going to, at this point, sell, take the profit, downsize, and get something a little bit less ostentatious.
Are you going to do a 15-year mortgage when you do that?
You know what? That's probably a good idea. I think we're in a good spot to do that because we could take the extra and go ahead and plow that back into the mortgage. So, yeah, we could do that to a down payment.
Or you could take Roger's idea and do a 30 and make 15-year payments, and you have a little more flexibility. Yeah. So I think for me, here's the takeaway with a mortgage. You're going to have one most likely at some point in your life, but I think the most retired folks I know that are successfully retired and living a good life at that time, their house is paid for.
Jonas, is bringing it back to you. It's so interesting. I've got a family member who, I mean, honestly, I love them to death. They don't cook for themselves. They eat out frequently or have like TV dinners or something like that. They literally, after their first house, they had a bad experience with it. They paid off all of their homes and have bought their next homes with cash since then in order to do this. And it's just, I mean, it's amazing. You can do it. You just have to put your mind to it.
Yeah. I'm not quite sure. I'd have to look at that financial plan a little bit deeper. But, we talked about getting in too big of a hurry to pay the mortgage off, and all the mortgage paid off parties that we see where people are burning the deed. And I always say kick the case of champagne back underneath the table, because if your house is 25 years old, it's breaking down just like the human body that's over 50 years old. So you're going to have,
I thought it was 70.
You pay cash. You
don't have to be 50.
But you get in a hurry, you pay cash for a house, and then all of a sudden your house is 25 years old, and then you're paying $15,000 to $20,000 a year for repairs, and you don't have any cash. You don't have a bucket strategy. You don't have an emergency fund. So I would have to, I'd have to kind of see what your relative was up to. I don't blame the fact that I think it is a financial plan, but there may have been some better things to do with that cash.
Yeah, it was an emotional thing. Because of
absolutely.
So that was
I'm
really
glad you shared that, because most financial decisions, I'm glad you said that, Doug, because I'll kick this over to the guys. How many huge, major financial decisions have you seen that were just based on pure emotion, that people come back and they rationalize it with some type of math, but they've just did it for pure emotions first? It was just a pure emotional decision, like buying a house or
in general, a lot of decisions are made with emotion, especially a house, I think, right? That's like a very, because there's what you think you want, maybe what you want, then there's what's available. And I think it's easy to get caught up in the emotions of, I really like, it's like a shiny new toy, right? Especially if you're out shopping for a house. Yeah. I like all these things about it. It's going to be, but maybe it should be a lifestyle investment.
Well, it's not
maybe not just an emotional decision.
Not just a house, though. It's a hearth and home thing too, and that gets to the emotional part of this, Roger. As far as this is where I want my kids to remember growing up, and I want to have this place so that we can create these memories.
Do you think that still exists today?
Yeah, I do. I mean,
do you have that discussion in your house, Elias? I'm just going back. People under 50.
Right.
Do you have that discussion in your house
about just like being somewhere?
Yeah, like this is where I want to have all the memories and hearth and home. That doesn't exist in our house.
Yeah.
Not good or bad,
Right,
but
right.
we don't own a house because our goal is to build these grandiose memories. We
Right.
build a house or live in a house
Right.
that fits the needs of our family,
Mhm.
the size that we want, the amenities we want to enjoy. Our intent's to not really own it forever.
Mhm.
Because, I mean, what you're alluding to is we're going to buy a house and keep it for 30 years.
Right.
I don't know if that exists anymore, Doug.
Yeah.
One, I don't think people can afford at 40 years old
Mhm.
to buy the house they're going to live at for the next 30 years.
Mhm.
And I think we're a consumer society that says in 30 years, that's no longer what I'm going to want or need.
Yeah. It's sort of like there's nobody who works for the same company for 30 years. There's no ball players that play for the same
Right.
team over their career. It's changed over time. So
turnover.
I'm really reflecting what my parents, because they got their house in like 1953, something like that. And they owned it up until my sister bought it from them.
I think
in the
that used to be reality, but I even think of my parents.
Yeah.
I've lived in 4 different homes.
Mhm.
I mean, the house I grew up in, they sold when I graduated
Right.
college.
Mhm.
They were gone. So that wasn't really their intent.
Interesting.
But I think it's maybe just a generational shift of how people utilize and keep their home. And I think the other factor that goes into that, Doug, is it used to be, well, this is where we've always been. This is where we'll retire.
Mhm.
This is the home and that we built for everybody.
Right.
Well, a lot of people downsize when they retire. They're going to a condo. They're going to where there's no maintenance, or they're getting another property. And to get the other property, they have to sell one
Right.
because they need to downsize the price so they can get two. So I don't know if that's the reality anymore, that we just buy a place, we stay there for 30 years. In fact, me personally, I don't really know anybody who's
Yeah.
done that, but I know it used to be
Right.
completely commonplace to do that.
It's a very good point. I mean, it does make sense. It's just sort of the changing times, and really that's what is reflected when you go to Premier Investments and Wealth Management, because they understand this is that you know what, you may not have the same savings goals or investment goals as your parents did. Maybe you have an idea where you want to be one of these fire people where you retire as early as possible, or maybe you're saving for some sort of a legacy. At Premier Investments and Wealth Management, they can help you with things like that, and they can talk with you about you know what it is. Is it a 15-year or is it a 30-year where you pay off at the rate of a 15-year? This is the kind of important stuff that you get at Premier Investments and Wealth Management. I want you to go to premieriwm.com and specifically download their Investor's Guide to Changing Interest Rates. It's at premieriwm.com. Again, it's called the Investor's Guide to Changing Interest Rates. We're talking about that here with Elias Randel, with Jonas Everett, and with Roger Abel, president at Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Let's talk a little bit about the signs pointing a little bit towards an interest rate cut at the Fed meeting September. So what does it mean for you at this point? There's a lot of people who felt the rates increase mostly through credit cards. I mean, that was really the big thing.
We felt it all the way through society. I think it's important to kind of understand what lower interest rates means today and how it affects the average person listening to this show. And really, interest rates play a very important role in financial markets. Last fall, Elias, I'm going to set you up for this one. When people were worried about who the president was going to be, what did we tell them had more economic impact? The president or monetary policy?
Monetary policy.
Monetary policy. And we can see the impacts. We raised interest rates to slow the economy.
Right.
We've successfully done that. Inflation's under control. The employment situation isn't as good as it was. I think everybody can remember 2 years ago, we did a podcast, Elias, called The Great Resignation, where people were just going employer to employer because it was so easy to find a job. They'd pay you 20% more, and people are just flipping companies. Today, nobody's leaving because guess what? Not many people are hiring, which was reflected in the most recent data. So lowering rates should do the opposite. When we lower rates, it should stimulate the economy, which is why we haven't lowered interest rates yet. You know, the Fed is concerned that if we lower rates, it would supercharge inflation again. But now, you know, as of the last Fed meeting the meeting at Jackson Hole, the focus of the Fed is shifting towards employment,
Right.
and is more tolerable of a little bit hotter inflation than maybe that 2% target. Which, just so people know, the 2% target inflation rate, it's just made up.
Yeah.
There's no law. There's nothing that was passed. They just said, hey, this seems like a good rate. So it's just a made up number. Maybe it's 3. So I think things people can look for as we lower interest rates, you're going to see credit cards, interest rates come down. But think about this. The next interest rate cut is expected in September. If they lower it 0.25%, does that really affect you at all? Not really.
Right, on a day-to-day basis.
No, you're not going to notice it.
Yeah.
People won't notice it.
It's interesting, Jonas, when you talk about this, because you not only the interest rate cut they were talking about in Jackson Hole, but then it's coming to the end of Jerome Powell's term as the chairman of the Federal Reserve, and very political. Obviously, the president said, I want somebody that's going to come in, be aggressively cutting rates. It does have some potential impacts on different things and different investment instruments that you utilize at Premier Investments and Wealth Management, like, for example, on bonds.
Oh, absolutely. I mean, you have bonds have price sensitivity, basically. So if you have an interest rate cut, Doug, you're going to have the value of older bonds rise or go up because the newer bonds are being issued at a lower interest rate, and the older bonds have a higher interest rate. That's the good news. The bad news is the ongoing, if you have retired people living on a fixed income and they're trying to live on this bond yield is what they call it, the overall interest on the bond yield is going to be lower. So that might affect their living, their monthly income.
Right.
So it's all about price sensitivity with bonds when you have rate cuts or rate increases.
Elias, Randel, let's talk a little bit about the equity portion of this now. We've talked about the bonds. Let's talk about stocks. Potential rate cut, because I think they always say when nothing happens when a move is made, then they say, the market's already baked this into the whole thing. Or if something happens and afterwards they're like, the market did not expect this at all. I mean, it's you can't have it both ways. And I think that sometimes the market tries to. Talk about the potential impact of a rate cut on stocks.
So there's a couple things that can be impacted with investors and investor behavior. And you could see more people start to invest in equities. One thing I thought was interesting after the meeting at Jackson Hole, we had a big rally during that day. There was a certain point in the speech where Jerome Powell really alluded to starting to focus on inflation. And then that day, actually, the Dow did very well. And then there were some dividend-paying stocks that did very well. So I think it can impact people maybe looking for better yield. They might move to dividend-paying stocks. It can also impact valuations of companies through a few different ways. If they can borrow money for cheaper, they can grow their company at a less cost. And you can also discount the current cash flow. And so lower interest rates tend to be good for the equity markets and good for stock valuations in general. So I felt like that day of the meeting, it was kind of like dividend stocks really had a good benefit that day from that. And there could be differences as rates go down. You could see growth companies still kind of dominate the market too.
Yeah, Roger, a couple of different things with that is that you have the financial institutions, because you start lowering those interest rates, that makes their margin potential get squished, but you have other ones, growth. I mean, a lot of places where we see just billions of dollars of building and growth going on in companies, emerging sector companies, AI, high-tech, energy companies, things like that. That really frees up some capital for them to be able to do what they need to with less long-term debt.
Well, it also helps their stock price valuation. Think about it this way, when you can go buy just say a 2-year treasury and get 4%, it's a pretty good yield, right? You're less likely to go invest in a growth company hoping to make 10 or 12% when you can get 4 on a government bond. Well, if the 2-year treasury paid 1, that inherently makes that growth stock more valuable, because if you're going to get no growth, you're only getting 1%, you'll go buy the growth company and wait for the growth. Like, you'll go there. But I think people have overestimated what a rate cut's going to do to the real estate market. They're vastly overestimating what's going to happen. And I think this is, people hear interest rates and they assume they're all the same. I think the first thing to recognize is that mortgages, real estate interest rates are priced typically off of the 10-year treasury, not off of the Fed funds rate, which is when they are talking about lowering interest rates. It's the overnight lending rate. That's all that is. It's just, it's called the Fed funds rate. It's not the mortgage rate. They can lower the Fed funds rate a quarter point and have no effect on mortgage rates. And I think people believe, oh, we cut rates, mortgages are coming down. Not necessarily. Doesn't mean those rates are going to come down. Now, if we have an extended period of interest rate cuts, which is expected to happen, if you wanted to know what is expected in the interest rate market, you can go out to a tool called FedWatch. It's run by the CME, the Chicago Mercantile Exchange, and it'll show you what the expected interest rates are all the way up to December. Mm-hmm. So you can say, oh, we expect it to be a half a point lower. Right. As we continue to lower rates, that will trickle down into residential mortgages, commercial mortgages. And honestly, as rates come down, what happens? Demand goes up. It's a really simple, equation. Lower interest rates, demand up.
Mm-hmm. Makes sense.
And to your point, though, just the reserve cuts rates doesn't mean 10-year treasury is going to trade down in yield. That doesn't mean the yield on the 10-year treasury is going down.
The 10-year treasury actually went up the day after Jackson Hole. The yield on the 10-year treasury went up because the 10-year treasury is not just a reflection of the overnight lending rate. It's actually somewhat a reflection of the credit paying ability of the United States. If we become less creditworthy, the 10-year yield can go up and overnight rates can go down. So there's not a direct correlation between cutting rates and the 10-year treasury.
And U.S. credit was downgraded. Right. Now it went from the best rating to the next one down. So it's still very credit worthy. Is that the way to say that? Yeah. So it's not like it was a huge downgrade, but two different credit agencies downgraded the U.S. A bunch of other ones had already done it previously.
Yeah. Let's talk about in the next 4 or 5 minutes, and I'm going to go back to you, Jonas, about for the investors, what they need to be concerned about, if anything, because, you have these where you have a lower interest rate. It could, maybe get people to consider being a little more, less risk averse with their investment options, because they want to get the better yield.
Absolutely. You have fixed income investors. When interest rates go down, they may be looking at different investments that do pay a higher yield, but they don't realize that they're actually taking more risk to get that higher yield. So again, back to the financial plan, you need to make sure you identify your risk level, and I think that lower interest rates, just how it's going to affect me and my customers is the bucket number 2, Doug, in the bucket strategy. This is the 3 to the 5 year money where we're trying to get an interest yield. I'm going to expect that interest yield to go down. And I'm going to have to talk to my customers about that, and especially if they're taking some income from that, because they have been, averaging a very decent interest yield on that bucket of money. That's kind of a shorter term 3 to 5 year bucket of money.
Right. Roger, let's finish this up by talking about the importance of making sure that you remain diversified when you're heading into a situation like this.
This makes me think about we've been in a higher interest rate environment for a couple of years now, so people are used to getting 4-ish% on their relatively safe money. But before 2020, interest rates, you weren't getting 4% on anything.
Nothing.
And one of the things we saw during that period of time is people were stretching for yield, trying to buy investments that had 8, 9, 10% yield on them. I think everybody listening to the show needs to remember, the higher the return, the more risk. Even if it's a dividend or a bond, if it pays a higher yield, you are assuming more risk. There were some investments out there that were really popular 2013, 14, 15, paying 9, 10, 11% interest rates. Guess what happened to those investments? The share price went down 80%. That's why they were paying those yields, because you had to take a disproportionate amount of risk. So staying diversified is important, because this is when it gets dangerous for people. They've been used to getting 4, 5, 6%, relatively safe. They don't want to change that distribution they're getting, that yield. Well, if rates come down, you're going to have to take more risk to get a 5, 6, 7% distribution.
Yeah, you don't even necessarily talk about risk aversion or anything like that. How do you talk about this with your clients when you're talking about it? It's not about the potential risk potential and how comfortable they feel with it. There's something else that you call that.
We quantify their risk capacity.
Thank you. The risk capacity. Which
create a financial plan. Figure out for each individual client, their very unique and personal situation, how much risk they need to take to be successful. Then we match portfolios to that.
Yeah, it's risk capacity. This is stuff that you can find out by going to Premier Investments website at premieriwm.com and download the Investor's Guide, again, at premieriwm.com. While you're there, also click Get Started and answer a few questions. They will provide for you a one-page Premier Vision document. Do you know if you're ready for retirement? Odds are you don't. This is a wonderful opportunity for you to get the professionals at Premier Investments and Wealth Management on your side, working alongside you. Premier Investments and Wealth Management named to Forbes 2025 Best in State Wealth Management Teams. Again, premieriwm.com, or you can call 800-383-6590 with Roger Abel, Jonas, Everett, and Elias, Randel. Let's move forward and talk about retirement expectations versus reality. It's really interesting because we've been talking about this for a number of years, about when people think they can retire, when they actually do retire. But there's some other numbers in this report from Empower, a June 2025 report that was really interesting. Elias, start saving at age 27. I mean, that's something where I think both my kids were able to pull that off.
Well, that was, the American surveyed in this, kind of the general consensus was you should start by age 27. That's a great start. I think, why not start at 20 or 22? You know, you really can't start being an investor too early. There's no such thing as getting started too early. The other thing I found interesting on this was respondents say you should be able to retire at age 58. And for the people who have done a good job saving, I think there's more people out there that could retire before 60. They just don't know that they're financially independent at this point.
Is it because they don't have a financial plan, or they just don't have somebody who's keeping them keyed in with what's going on? Or maybe they just haven't asked that question.
It's a combination of all of those things. It's one, they've never asked anyone if they could retire. Sometimes you see people get anchored to a number. I've had conversations. I just want to have X in my portfolio before I retire. Sometimes that can keep people working. The most common thing, though, would be it's a lot of assumptions outside of, hey, I've done the work to figure out what's actually realistic for me. So there are people out there that they're already financially independent. They just don't know it either. No one's ever told them. They've never asked the right question, and maybe just they think that.
Right. Jonas, let's talk a little bit about the reality. There's a separate report that Transamerica Institute and the Transamerica Center for Retirement Studies did, and the news gets better the younger you get, it looks like.
Oh, absolutely. I mean, you're looking at before the baby boom generation, they started to save at 30 and 35, the study says. Now the Gen Z generation is saving at 20 and 25. What I thought that was kind of interesting about this study was everybody from the first survey said, oh, yeah, I'm going to retire at 58. But the reality is that males are retiring at 64 and females are retiring at 62.
Yeah.
So it goes back to the three different, you're going to have three different exits in retirement, and you have to plan for all three. You're going to either you're going to retire early, you're going to retire when you expect to retire, or you're going to work later. But I thought that was interesting that last study by the retirement research at Boston College said 64 for males, 62 for females.
Yeah. Roger, I'm going to make an analogy here is that I know that there are some cities where the sanitation workers, they start, they get started 4 a.m. and they start work and they do their thing because the city who employs them says, when you get done, you're done and you get paid for 8 hours. But if you get done by 8:30 a.m., you're getting paid for 8 hours no matter what. So starting early and working diligently can really, really pay off. It can also pay off in your favor if you start saving early and do it really diligently because the power of
compound interest. Oh, we said it together. No, I think it's good you brought that up because so many times we talk with young investors and families about the importance of saving early, but we actually don't bring up the term compound interest as the reason you need to save early.
Yeah.
We just say, hey, you need to save early. Well, it's because you get your money working for you. I remember I started for a company owned by Transamerica when I started in the business. We used to have this chart called Investor A and Investor B. Investor A saved for the first 10 years of retirement, then never saved another dime. Investor B waited 10 years, saved for the next 30 years. So he saved 3 times as much money.
Yeah.
Guess who still had more money in the end?
Investor A.
Investor A.
Yeah.
So we don't talk about that, but compound interest really is the beauty. There's a great little rule out there. If someone wants to figure out how this works, it's called the rule of 72.
Okay.
So if you take 72 divided by your interest rate that you expect to earn. So if you think you're going to average 10% a year, 72 divided by 10 is 7.2. That's how many years it takes for your money to double.
Okay.
So if you had $100,000 in year 25 and you plan on working for another 28 years, so 53, you have what? 4 doubles?
Yeah.
So 100 turns to 2, to 4, to 8, to 1.6. So the sooner you can get 100,000 put away, the faster it works for you.
Yeah.
And I can tell you that here's what's ironic about investing. I really believe it's a race to 100,000.
Okay.
Because that's when numbers start to get a little real. If you've got $10,000 saved and the stock market goes up 10%, it went up like $1,000.
Yeah.
Doesn't excite anybody. When you have $1 million saved and it goes up 10%, it's 100,000. But the faster you can get $100,000 put away, the faster this stuff just starts to multiply.
That leads
big
to
numbers.
my quiz question of the day, Doug.
What's that?
Guess
No.
how many thousands of 401k millionaires there are in the United States right now?
Oh, hundreds of thousands.
Take a wild
Billions.
guess.
I have no clue. I honestly don't.
400,000
400,000 401k millionaires.
And that's just 401k. That doesn't
That's
include
just for-
IRAs,
that's
Roth
right.
IRAs.
So Roger's exactly right. They all had to get to the point where they crossed that $100,000 finish line, and then compound growth kind of took over. But ultimately they started. It looks like if you're a baby boom, you started at 30 or 35. But the Gen Zs, if they can get started at 20 or 25, then they're investor A.
Yeah.
well, I
They're
mean,
10 years early.
if you polled everybody in this room and you polled everybody you know, the vast majority of people are going to tell you, I wish I would have saved sooner. Wish I would have.
Right.
I guarantee Jonas said he wished he would have. Elias, do you?
Yeah,
you do.
for sure.
Scope. Molly, how about you? She's listening diligently. Everybody will tell you they wish they would have saved sooner, but we all find excuses why we can't do
Right.
it. I think a lot of times people believe it takes a lot of money to get a lot of money. It doesn't. It's built a little bit, saved over a long period of time. That's how it's built.
So a friend of mine growing up, his dad would make him take the money he was making and put it in a Roth, right? So can you imagine being 16 years old and you probably just think, what a scoundrel, my father.
Scoundrel.
Right.
Forcing me to not have any fun with my
Meanwhile,
money.
he's got $1 million at age 36 years old.
Yeah, and now we're in our mid 30s, and I've never asked him like, what do you already have in your Roth? But and he's been a good saver too since he's been working. A lot of it was the habits his dad helped him establish. But if you started at 16, at 36, like
Yeah.
36, 37. What do you think you got in that Roth?
That's amazing.
Maybe $500,000 already?
Depends on how much he's putting in there and how diligent he or she got later on.
It's called a good start, is what it is.
Absolutely.
Right.
Well-
but that's the point. It was and he's even told me this. I used to think it was the dumbest idea ever. He goes, but now that I'm, working and established, I'm very thankful that he had me start doing that because it's really paid off.
So that exercise your friend's dad had him do is actually less about the money he was going to accumulate over 50 years and more about the habit of teaching his son or daughter that when we get paid, we have to set a little bit away. Seriously. Yeah. I don't think if he had zero, but he learned that skill and he didn't really start, he or she did it till they're 20 or 25, they're just making it ingrained into their processing of how they do things. Hey, we need to save a little bit. Just like the stuff we do with our kids. My kids get money for school or get money for birthdays or whatever. Yeah. Okay. 3 options. You can save it all, save none of it, spend it all, or do a little both. Guess what most people opt for?
Do a little both.
Little both. So if you can teach it to them at a young age, now my oldest daughter doesn't spend any of it. My youngest daughter would spend all of it.
Yeah, so
let's talk about that. I'm really interested in that.
Real quick before we do there, I want to remind people that they can go over to Premier Investments website at premieriwm.com and check out all these ideas. They've got a lot of downloadable information over there. My 40th class reunion, we were talking about with the guys here a little bit. If I wanted, I wish I could go back, Roger, and tell 18-year-old or 17-year-old Doug about what they should be doing. It would have made a huge difference in making the right choices. You can help your kids, your grandkids start in with this. You can do it yourself. PremierIWM.com is the website. While you're there, click Get Started, answer a few questions, get your one-page Premier Vision document. They'll give you a free, no-obligation consultation to go over it with you. They'll hand it to you. You can walk out the door so you can find out, am I ready for retirement? Am I ready for paying for part of my kid's education or for whatever fabulous idea of a dream purchase that I want in the future? PremierIWM.com is the website. Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams, 800-383-6590. Jonas.
Yeah, I was just thought of this being kind of philosophic here. Why do people save? Why do people save?
I can give the answer. Most people don't know why they're saving. They just think they're supposed to. You're saving money for one reason only, to turn that money into income. That's why you save for retirement. You could be shorting. Independence. Yeah, but financial independence is the ability to generate enough income from what you saved to live on. I think that's a good question because a lot of people they save because they think they're supposed to. They don't know why. They don't. They're like, well, I'm supposed to save X amount percentage. Yeah. They're not thinking about, hey, at some point when I can't work, I have to use the money I've saved to generate income so I can still live and get by financially.
I think that's a great exercise for young people and anybody, really. If they just write down, wiggle the pen, write down, why do I save? ? And just put their own answers in there.
It makes sense because you're getting to the heart of this as you talk about investing being something that's not just a monetary thing. It's very psychological. It's very emotional, too. There may be people who, like my family member, the way they paid off that house was based on fear. That's just 100% fear. That's the way that they did what they did. And there are other reasons why people, but the whole thing is you want to make sure that you're going through this setting realistic expectations as you walk through this too. Not only because you can start saving. If you're young and you start saving, you see that just that little bit build up. Once you hit that point where the cascade tips, Elias, where your money starts working for you rather than you working for your money so hard.
There's a few things you can do to really stay on track. And I think realistic expectations is a good starting place where, okay, if you're in your 20s, can you save 20 or 25,000 a year? Probably not, right? You're just getting started. Could you break it down and save $50 a week? Could you put $50 a week away somewhere? Okay, can't do that. Can you do 25? So I think with realistic expectations, you're going to find a good starting place for you. And when you're young, you know, we've been kind of going on and on. You can't really start too young. And then as time goes, you can make incremental increases and increase your contributions over time. And I know a lot of times I recommend to our young investors, because I'll ask them, like, what can you save? Like, what's your goal? What can you save every month? Let's just, for ease of conversation, say the answer is that I can save $1,000 a month, you know, and they're 23 or 24 years old. Well, what if we start with half of that so we don't get too ambitious and now we're saving so much and then we have an emergency we can't pay for, right? And then we got to backtrack. So you can do things like that too. I can do the X, so I'm going to do half, and then next year I'm going to increase it by $100 or whatever it is. So I think if you lay out some strategy and a game plan of how you can accomplish it and a roadmap, you'll find that you can be successful as long as you execute the things you set out to execute along the way.
It's really simple. For young people, do you want to sacrifice your lifestyle today, or do you want to sacrifice your lifestyle in 20 years? Here's why. When you're 24, you don't really have any money to have any lifestyle anyway.
I was just thinking that.
Like,
what kind of lifestyle can you have?
But
when
if
you're
you don't
24
save when
years
you're
old?
24, when you're 40, you're going to have to save a disproportionate amount of your income to catch up.
Yeah.
So you can sacrifice it when you don't have any lifestyle, when you think you have lifestyle, going to Chick-fil-A. I love to beat up on Chick-fil-A or Starbucks. When you think you have it, or when you're 40 and 50 years old, when you could be in a great financial position, your best earning years, enjoying the fruits of your labor instead of playing catch up for the first 20 years that you squandered it away.
Yeah.
It's really, really simple.
And I would add to that, if you don't see it, you won't spend it. So I think that the man on the street, you look at the data on the 401k millionaires, if you don't see it, you won't spend it. Is a 401k the best vehicle out there? Probably. I don't know. I don't know if it is, but you just don't see it.
Well, it's
so
the
you
best
won't spend
vehicle
it.
because you'll actually do it and save it. All the other vehicles people talk about in theory that could be better. Well, guess what? The only way it's better is if you actually execute it.
Yeah.
And 95% of the people will not execute it.
Kind of like a diet, right?
Yeah. In theory, this is what I do. Well, how many people do it? They don't.
Yeah. Big thing is making sure that you have a plan. I mean, that's one of the critical things, and that's what you preach at Premier Investments and Wealth Management, is that this a la carte thing, I mean, it's a good thing to start there, but you're talking about putting it together with a plan, because the bucket strategy, Elias, means that not only are they saving for investing for the future, but they're having savings for current potential emergencies, as well as money that goes into other things than long-term retirement necessarily, retirement instruments.
It's all those things. Life events happen. People's careers change. People have emergencies. There's constantly all these moving parts and decisions that need to be made. So I think if you have a foundation, and when you're getting started out, even if you're beyond getting started out and you're middle-aged, if you have a strong foundation and you have good habits, you're going to be able to make adjustments along the way to address a life event, address an emergency that comes up. Maybe have a job opportunity somewhere you really want to be and now you need to relocate. There's a lot of things that can happen along the way. And if you're executing some very basic things, you can stay on the path, make adjustments, and just kind of keep marching up the mountain.
Yeah. And it makes sense too, because you're talking about reviewing the plan on a regular basis, but you can do that. I mean, maybe you're young and you accumulate all this information. If you have a financial professional that you work with on a regular basis, they're the ones that get to do all that. You can go about living life, and they're the ones that can help you institute the plan.
We just did a podcast a couple weeks ago, Elias, on how much time it saves the average investor to delegate it. We'll have to pull that out. It was like between 2 and 5 hours a week of just pure capacity with saving people. Well, just think about that.
Yeah.
Like, just because they don't have to doom scroll and go through all the different, websites to figure out what they're supposed to do. They're letting someone else do it. They're filtering out the noise, and they can allocate all their time to things that they actually like to do. So it really comes down to working with the professionals. 3 things. It's really 4 things now. Do you have the time, the desire, the knowledge, and the technology to implement it. And most people, they don't. They might think they do, but they don't.
And that's why you go to Premier Investments in Wealth Management, because they do have these things. If you go to premieriwm.com, you'll find out. Nice thing about this is that you click Get Started while you're at that website. You answer a few questions. They create what's called a one-page Premier Vision document that can help you as your roadmap to your financial future for investing, for retirement, for whatever your dream purchase is. Maybe you want to leave a legacy. Maybe you want to send your kids to college and have them have no debt. It's ambitious, but you know what? If you have the professionals at Premier Investments in Wealth Management on your side, they're the ones that are going to be doing the work for you. Think of them as the financial change in the tire on the side of the road. That's what the wealth management plan can do for you. Get them involved today. PremierIWM.com, Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Team. Call today, 800-383-6590. For Roger Abel, for Jonas Everett, for Elias Randel, I'm Doug Wagner. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks including possible loss of principal.
There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.